Good morning, everybody. Welcome back to the Schwab YouTube coaching channel for our Thursday edition of Trader Talk in today's market. I am your host, Kevin Horner, joining you from a chilly morning here in Denver, Colorado. I want to say hi to all of you. Thanks for being here with me today. Lots of usual suspects I see in the chat there. I am joined today by my friend Brett Crowder today in the chat. Make sure you say hey to Brett. He'll be managing commentary that I'm unable to get to, but you all know I love keeping an eye on things there. Would love to hear from you throughout the 45-minute opportunity here going forward. So please feel free to post in there. I'll try to answer questions along the way, and we will go from there. As always, you can follow us on X. I am available there at Kevin Horner CS, and it looks to me like Brett is also available there at Brett Crowder CS. So you can follow us there on X. We do try to post for you throughout the week. In fact, I got a new video out this morning just about utilizing some generic and basic concepts of technical analysis. You know, sometimes we get a little bit too far afield from our process and we can find ourselves getting a little too advanced maybe, or too outside the box. It can be really easy to just fall back on some of your simple ideas. So keep this in mind as you go forward, everyone, because those opportunities can sometimes be better suitable if we just keep in mind some of the basics along the way. So anyway, with that, I'm going to remind you want to be subscribed to the YouTube channel here, and then I'm going to get to some disclosures and we'll dive right on into the discussion. So please remember that our discussion and conversations here are exclusively for your information and your education. We do not make recommendations. We do not make endorsements for a specific approach to trading the market. Further, we do talk technical analysis here. In doing so, we remind you that it's merely one piece of your decision-making puzzle, everyone. We do not encourage you to make decisions exclusively on technical analysis. If you're new to our trading, Trader Talk segment here, we are live 4 days a week, but I'll remind you that our agenda is pretty consistent. We take a top-down approach, so we'll look at the larger of our indice groups. So we'll hit up the S&P 500. We'll look at the NASDAQ 100, the Russell 2000, semiconductors. I'm going to spend a little time today exploring some of the macro detail that you all like to ask for on a Thursday session with me going solo for all of you. So I've got some Dow theory stuff, some look at stocks that are above their 200-day moving averages, 50-day moving averages in the S&P, et cetera. So we're just going to get a little bit of clarity here on the macro viewpoint as well today. So as usual, plenty to get to. So we're going to lead with the S&P this morning, as we always do. I'm going to bring up we got about a 0.1 pop off of the day we had yesterday. And, you know, it continues to be one of these deals where we are riding that trend, doesn't it? Depending on your time frame. Maybe you're a 20-day trader. Maybe you're that 50-day trader. But one of those scenarios would have kept you in the S&P 500 trade all the way back to May 1, the 50-day moving average, that is. As you can see, now if I were to make a quick alteration here to my chart and put my tools back on, one of the details we could do is just show the 50-day here exclusively, and you'll see we recaptured that on May 1 after our tariff tantrum back in early April, our Liberation Day, if you will. And that worked out if you were a buyer above the 50-day moving average, allowing the trend to reassert itself. Whether you chose to do so on that initial day through the 50-day, or you said, I'll wait and allow this little consolidation. You might have waited for the gap, which nobody would fault you here. You know, if you decided to buy based on that gap move that morning, that would have probably been one of those instances where you would have maintained comfort along the way. So whether you're a buyer initially or you needed more confirmation, if you've been utilizing the 50-day along the way, there's not been a reason as of yet to be a seller, right? You haven't had that definite indication. Now, if we put the 20-day in there instead, this is where you'll see we've had a little more, especially in the last 3 weeks here, a little more consternation, right? We've been in and around the 50-day. Your tests of the 50-day have been the 20-day, I apologize. Your tests of the 20 have been opportunistic for joining the trend, participating at a low risk area like this. So these have been working, okay? But the reason I bring it up is it's a wonderful reminder that we as traders, we must define the time frame in which we would like to be trading. Now, in terms of management, reminder, you don't have to go exclusively with the 20. You don't have to go exclusively with the 50. Many of you might utilize the idea that you're going to work with both. And maybe you're going to maintain the broadest of your position, the largest portion of your position, so long as it maintains that 20, 50, or 20 and 50-day moving averages. But if you're one of those traders in the short run who says, you know what, under the 20-day, I'm going to lighten up a little bit. Let's see what happens. And then if we get to the 50-day test and hold, then we can find ourselves sticking with things. And there's nothing wrong with that, everybody. So always have that underlying familiarity, or at least the underlying willingness to manage your trades to your comfort as you start working through these things, right? So have a few of those processes laid out and make those decisions in the moment substantially easier just by simply giving yourself that entire playbook. Now, let's go ahead and put up my all my moving. Oh, my goodness, I'm going to do a little teaching moment here, everybody. I've got a 20, 50, and 200-day list or link here into my tools, and I thought this was simply my 20, 50, 200. So I'm going to take this one here and delete the returns and maintain just the 20, 50, and 200-day moving averages there. I've lifted those return details, as you can see. We do have some classes where we've kind of covered this My Tools section, but I'll tell you what, in the last few months here, we have absolutely seen this thing expanded and exploded. If you're not utilizing these quick features to access areas of your charting and your processes, you may very well be missing out. If you're looking for a little bit more, go into the YouTube Trader Talks page and maybe just search specifically for the My Tools. My Tools is this banner along the top, is where it's most commonly located, but we have a few options there. So if you'd like to see us ways that you can utilize that My Tools, maybe check that out there on the channel. Let's see. Now, I wanted to address here the question about whether we might be looking at a little bit of a short-term head and shoulder. It's possible, yes, but I think the reminder that I want to offer is that we tend as traders to fall into this desire to define every pattern we see as matching up with something that we should know. Yes, could it be a little head and shoulder-ish? Sure. You've got a left shoulder here, maybe the right shoulder here, that head slightly above. That has the makeup, the component makeup of a bit of a head and shoulder top. I'm absolutely going to remind you that, yeah, that you could say that. Now, the further reminder is every pattern we see is merely a potential pattern until it plays out that way. So what would we need to see from the S&P to validate a so-called head and shoulder top? And that would be a breakdown below what many would call the neckline. And the neckline in this case would perhaps be in the ballpark of about 65.30. You can see that has been a level that we've tested in the S&P a few times. So, in doing so, we would be under the 20-day, we'd be under the 50-day. And if we traded under that white line, then we would have taken out horizontal support as well. That definitely becomes a bit problematic for the S&P 500, particularly on a closing basis. Now, once more, traders got to define your confirmation, right? That's the Horner rule. Define your own confirmation. Is it one day below an area of support? Is it 2 consecutive closes under support? Is it 3 consecutive closes under support that validates it? Have those rules so that you know what you're going to do to act, okay? Now, I'll remind you, whether we call it a head and shoulder top or not, doesn't matter. What does matter, I think, is the action, right? And I think for a lot of traders, a close under that 65.40, the white line here, whether you know that this is head and shoulder or not, this level looks very important based on what we've seen here, everyone. I think you would all agree. We have basically maintained that ledge since September 11. So here we are now, about 6 weeks down the road. And if that were to break, I think a lot of traders would agree that it would be a significant development. And then we'd have to start looking for some support levels beneath that. Okay. So let's see how the NASDAQ is bouncing back after a pretty healthy or tricky day yesterday. I think a lot of you, and of course, a lot of what we say about the S&P can be applied to the NASDAQ. There's a ton of consistency between these. So this looks much more like consolidation. I tend to agree here with you, Nitro, a little bit more like consolidation in this period. We do have numerous catalysts that could make this an availability for you, though, right? Earnings are here. We're listening to a lot of those earnings. We're absolutely going to be talking about Tesla a little bit later. So there are catalysts that could bring this market to continuations of the upside trend, but could also bring us to an area of support. So let's go ahead and be prepared for the things we may not expect to see. It's one thing to plan your trades and have everything on one side of the market, right? But the reminder I have to offer consistently is that it can be just as important, if not more so, to start evaluating the charts from a standpoint of, hey, what if I'm wrong? What if I am bad about my entry points? Or what if my timing is wrong? Or what if I look at this and what I think is happening is not happening? What would that look like? Putting yourself on that side of the table can be really, really helpful. What I found for me is that it often encourages me to taking smaller position sizes, which can be a good positive as well. That means when things do, in fact, go against me, I'm not getting beaten up the way that I may have previously. So hopefully another helpful reminder. In terms of the trend here, waning a little, still looks like consolidation. I would probably take your comment about the SPX and apply it to what we see in the NDX here as well. We do have a divergence here in the RSI below, so we're going to monitor that. But I'll simply remind you about the RSI being divergent does not imply reversal. Most consistently, the implication of a bearish divergence in RSI leads to pauses in the trend rather than reversals in trend. All right, let's look at the Russell, the small caps. Getting another bounce here today. We're still trying to hold that white line. We probably need a little more time to validate that. Why are we looking at that white line? It's this long range chart. You can see, I believe, everyone, if I put an oval on basically the action of the last 5 weeks here, you can see we have tried to push the small caps to new highs, right? And we have made new intra-week highs, but we have not held as of yet. So it does look bullish. New highs are not bearish by any stretch, so we're not going to overthink this here. But we would like to see some semblance of confirmation, some indication that we can move to new highs. Closing at new highs on a weekly viewpoint would not be bad at all. I'm sure there's many small cap traders out there looking for that type of confirmation. Now, of course, considering what we get out of small caps, we have to look at yields. So we're going to pull up the 10-year. The 10-year has still downtrending pretty aggressively here. And I think you can all see the last time that I got to host this show a couple of weeks ago, I think it's been at least 2 weeks now, we were talking about potentially breaking out. That's why that oval was there, because we had made this bounce and into the resistance, held the 20-day. We were feeling like there was a potential opportunity to see yields kind of climbing from here. So that's not the fact that we've rejected at that trend line might continue to bode well for small caps. You'll see that with our continued slide in yield, pulling lower, maintaining a level under 4%. Reminder here, when we were looking at this particular symbol, the TNX:CGI, this is just simply moving one decimal to the left will give you the approximation of yield. So we would say that the last here at 39.86 3.98, the approximation of your yield. Okay, so falling rates, good for small caps. Falling rates, maybe not as good for utilities necessarily, but let's look as a component of yields falling, we should also peek in on the dollar, and let's just quickly look at how this is settled out. Well, this is starting to look a little interesting from the standpoint of a broken downtrend. Now, we can see that broken downtrend in the form of my white line here, right? But what we also notice is that we've made a double bottom. So I'm going to highlight that here. Double bottom. Here's our second bottom and our first, of course, over here, right? Now, why is that significant? Well, it could mean that the dollar is due for a rally. And yes, we have a series of higher lows along the way from that last check-in, right? We also have a divergence, bullish divergence at those last lows. So some traders would tell you that gives them the comfort to say, all right, this low that we just tested at around 96.30, that is a level that is maybe more likely to be held now than to be broken. That does not mean it only goes up from here, of course, but what it does do is maybe give traders some confidence in the opportunity for the dollar to start rallying from here more so than continuing its downtrend. A couple other things of note. I'll pull back on my line here. You'll notice 20 crossing the 50-day moving average to the upside. The confluence of data right there, pretty strong support given the nature of the move after breaking the trend. If you get through that last peak, or perhaps get through that red line, the second red line there at around 150 cents or so, then that does provide some possible opportunity, of course. Okay. Now, when I say opportunity, I'm saying opportunity for long dollar. The concern, and this is a great point that you're mentioning here, Jan, if the dollar rallies, international stocks are likely to start underperforming. That's not exclusive to international, right? What companies in our market are the most likely to struggle in a rising dollar environment? Our largest and most multinational companies. The companies that are doing business worldwide are more likely to underperform. Now, remember, underperformance does not mean negative returns. I hope I can point that out. I think it's very important to keep some of these very basic concepts in mind. No, we don't mean that a rising dollar will lead to terrible returns, negative returns, right? It just might mean lagging returns, all right? So always have that little bit of context in your back pocket, so to speak. Okay, so there's a look at the dollar. Let's do some more broad macro stuff. The chart that I like to bring here, of course, is one that our friend Rachel Deshelle has provided in the past, and that is our look at the S&P 500 stocks over the 200-day moving average, stocks over their 50-day moving average. That's the second line here. And then we have the NYSE stocks making new highs and making new lows. Now, the lows do not stand out. I mean, maybe it stands out because stocks in the NYSE making new lows are at an ultimately low level. That's a positive for the broad market, generally speaking. But when you take a look at the NYSE stocks making new highs, well, you can see we are also not exactly trending wonderfully here, right? You could see that we had peaked in this case back in September, and we've kind of been streaming lower to that. That's not exactly giving us the broadening out that we might be searching for, but it might also just simply be a little bit more of pause in what we've noted. When I look at the 50-day stocks over the 50-day in the S&P 500 and those over the 200-day at the top in the S&P 500, the thing that stands out here, of course, is trend. Remember, it's great that we're above the 200-day, but that is a much longer trend than the shorter one, right? A 50-day moving average tells us that we're maybe not seeing as many stocks in that strong intermediate window of time in the trend. Now, look at how it looked wonderfully when we rallied, right? When we had that April 7 bottom, look how strong the move was. and we peaked here in the neighborhood of about 78, 79% of the S&P 500 there in above their 50-day moving averages. So this is a spot where we would like to see this moving higher. If I was maybe looking at it from a standpoint of the trend, you could perhaps draw a line like so and say, you know what, if we could get that trend back to an uptrend, well, then we might start feeling a lot more comfortable with what we've seen from the SPX. So maybe implication being a little bit of a pause. We'll see. Now, how about what's happening in Dow theory? Let me pull up that chart here. All right. Now, we talked about this the last time I was with all of you, I believe. What is Dow theory? Dow theory simply states, and by the way, this goes back about 150 years, of course, so it's not a new concept, but the idea here is simply we want confirmation in the form of two major groups moving in the same way. If the Dow Jones Industrials over here on the left are making highs, as we see they have just this week, well, we want to see the Dow Transports doing the same. Today, we are not getting that confirmation, okay? Now, does that mean that we can't continue to trend higher? No, it does not. Does it mean that some longer-term investors are paying attention and waiting for a shift in what we've seen from the transports? It very well could. Remember, transports are often considered to be a little bit of a leading indicator because of the nature of transports. They are telling us about the way and the strength of what we are shipping and moving from across the country and importing to the country as well. So when things in transports slow down, well, that kind of gives you a little bit of a heads up. Some of the other things that are in part of transports, and you may not have expected, things like Uber and Lyft are considered part of transportation. And it doesn't necessarily make a whole lot of sense broadly, but if those ride-sharing groups are showing, just as merely as an example, not a definitive in any way, if they're showing that these areas where they traditionally have huge volume, New York City, Las Vegas, Chicago, LA, etc., these places that consistently show high numbers of usage, lots of traffic from a standpoint of tourism, for example, that can be really instructive. But if that stuff is waning, well, then that might be telling us something about the strength or health of this of the economy, right? So the thing that stands out to me as a chartist looking at this trend here in the transports on the right specifically is the failure at former resistance. Former resistance just being consistent level that we had previously rallied into and pulled back from. And here we've seen lower highs since then. And in fact, if I drilled in a little bit, you'll notice that we've failed at that downtrend line with some tails here quite a few times over the last few months. So again, it bears watching. So the one final note is the importance of the white line here. Yes, it would be ideal to trade above the downtrending white line, but a breakdown in transports under the white line that I've drawn in here could be quite difficult for the broader market to manage and deal with. So I think it's important to keep an eye on this. And as such, I'm happy to share this with you, Silas. You got it. Let me go ahead and share the grid. I'll remind you all with grids, scripts, etc., these details that we share with you, these are not guaranteed for accuracy. These scripts are not guaranteed for timing and not a recommendation for their use. But I think if it was something for you to maybe just simply monitor and maybe throw on one of your alternate monitors for day-to-day, week-to-week check-ins, not a bad plan in a way, just to kind of keep an eye on things here. All right, so there's your Dow theory. The last note I'm going to make, and this is going to be a perfect, I hope a perfect segue into looking at the semiconductors, is just to remind you, as I often state, it's a very different market than it was when Charles Dow started developing Dow theory in the late 1800s. We were an economy built on production. We are no longer an economy built on production, but rather consumption. And so with that in mind, some investors, some traders suggest you want to get your confirmation not from traditional Dow theory, but maybe something a little more in line with where we are today. And some traders suggest that that's a combination of the S&P 500 and the semiconductors. And you could say that you've got uptrends in both the S&P and the SOX here. Notice today, the one thing that I think has been consistent amongst all of the major indices yesterday, in the S&P, the NASDAQ 100, the Russell, the SOX, they all had this nice lengthy tail beneath the 20-day moving average, but a close above it. So at least on a one-day basis, yesterday's action may not have felt great, but it did provide for a lot of traders a view of a successful test of the 20-day simple moving average. Now, a lower low, now things maybe change, but we've not seen that, right? And so the first thing that would have to happen would likely be a takeout or a trade through, at least as it relates to the semis here, trade through an approximation of this level right about here, right around 65.40 on the SOX index itself. So kind of keeping an eye there on semis. Okay, outside of that, let's look at our sectors on the move here today. We have got some leadership from energy. Energy up 1.25. I got to pull back on my chart here. We had been kind of mired in this one, haven't we? We've talked about the multiple. There are multiple trends at work here within the energy space. You've got a longer range downtrend that I can probably turn to a red line for our own visual. Let's kick that line forward a little bit. So I'll just put this out to November 1, and that'll make that red line extend a little for us. There we go. So that gives you an approximation of maybe a zone of resistance up there, as does this horizontal resistance, which should probably also be red. And we can carry that out to about November 1. I hope you all notice I'm just simply changing the day here as I address my line, and that allows the line to get extended for me. I love cheating a little bit wherever I can. That way I don't have to worry about it maintaining my perfectly flat level. So I can just alter the date to which I want that line drawn. I like to play with it like that too. So, energy, not quite out of a trend just yet. But let's see how oil is acting as a relation to what we're getting from the energy space. All right, you're getting a bounce today, and could be said that we're getting a bounce off of an important level. Look at my previously drawn in lines in here, everyone. We'd gone into consolidation after breaking our upward channel. That consolidation did not hold, and we broke down, and now we have rallied into former support, now potential resistance. I'm going to edit that one more time. Let's make that line a little further. There we go. So there you go, right at resistance, coincident with the 50-day moving average. Pretty important level for oil there at this point. So that's certainly, if you're an energy bull, you might be looking for a move above the 50-day moving average that could allow it to challenge the 200-day moving average here in blue. That could be a possibility, and that could carry the energy space a little for a day or two, but not breaking a trend yet. So it certainly bears watching here if that's the case. In terms of additional movers, getting a bounce there today. Now, let's look at materials real quick. We're going to certainly get into precious metals momentarily, but you can see that while this has been, for a period, this was a real strong group, we have kind of consolidated over the last month plus and have maintained the 200-day by and large back to about July 1. So this is actually developing into what could be considered a new short-term support zone along that 200-day moving average in blue. I wonder how that looks on a longer range peak here. Whoops, that's not the one. There it is. Yeah, so that actually, when you see what you've got, what you have had working in materials dating back to May, an uptrend that's just been in brief pullback mode, essentially, but that's not a terrible look at what's been happening in materials by any means. So keeping it moving, let's look at industrials. All right, industrials into a consolidation mode. We've really just been going sideways by and large here for the last few months. Let's put another level up here so we've got something to monitor. You can see, yeah, there it is. I mean, they're basically rangy since July. So all of July, August, September, and 3 months, 3 weeks of October thus far. So you're nearly at 4 full months of consolidation. Now, why is that important? Well, 4 months of consolidation is one thing, but a break of that consolidation can lead to a trending situation. We just don't know which direction as of yet. So from a trader standpoint, trades under the white line down below could lead traders to be a little bit more defensive in the short run and expect maybe shorter term bearish trending, but a breakout could lead to some bullish trending thereafter. We'll have to see which direction this breaks. Again, you don't have to guess. For a lot of traders, it's as simple as allowing the pattern to develop and then taking the trade in the direction in which it breaks. Excuse me. Okay. In terms of some others, so I've noted the 10-year yield climbing a little today. And as kind of on the heels of that, we've got utilities pulling back a little bit, holding support, holding the 20-day. My question mark there is just tied to whether it's going to actually maintain support or not. And then notice real estate doing something kind of similar in terms of breathing today. I'd say for many traders, it might very well be a period right now where they're working to define confirmation. Is this confirmatory in nature, or is the fact that we've not traded above this ledge, the same level that we failed at last time, is this the level of import? You know, all of us traders are a little bit different. Just pays to have that all kind of figured out for ourselves, right? So be thoughtful, as always, in your process. And then the last thing I wanted to look at here before I want to get some stocks in the news and a real quick look at our example portfolio, which is diminished to nothing, unfortunately. I wanted to peek in on housing. You know, I mentioned this morning off the jump that I'd posted a video on X today, and it was actually utilizing this quick concept of what's happening with a group, in this case, the home builders, U.S. home construction, which was awesome for a period here, basically back to mid-June, or we could even take the June bottom here. What if we just said, let's take it from the low trade here and run it to our peak? You had an entire space that moved up more than 44% from peak to trough there, or pardon me, trough to peak. Wonderful, wonderful pop. But everything changed after we got kind of pulled back to the 50-day moving average. And I've drawn in a bit of a head and shoulder here. This one seems to be a little bit more prominent. We had the left shoulder created. We pulled back to the 20-day, popped higher, made the head, pulled back to the 20-day for a very quick pause before taking it out. Now, remember, at the time, this red line would have been green because we had moved through here, tested it right here, made a high, and came back for a test. Very common, very basic technical analysis 101 stuff. And then, while you might have been feeling very bullish because we found the 50-day, found horizontal support, bounced off of it, we rallied into the orange 20-day moving average. Why is that important? Well, along the way, where was our 20-day? Our 20-day was support right there, about right here, right here. So you had basic stuff working out, right? Higher high, pull back to a higher low, 20-day moving average test. Breakout to a higher high, pull back to a higher low, 20-day moving average test. What was support can then, once broken, become resistance. And unfortunately, that's exactly what happened with our first rally back into the 20-day. We failed, made a lower low, took out this green, became a red line because we traded below it. So that becomes the neckline of the head and shoulder pattern. So the head and shoulder top on this one in the short term has completed. And the question now is it rejecting at the neckline? If it is, bearish traders have risk versus reward in their favor here. But if it were to close above the highs we've had over since this day here, the October 7 day, the last 2 weeks basically, well, then that would perhaps give bulls a bit more confidence. Obviously, it's way too early to know, but we are at a crux point for at least the U.S. home construction. I thought this was an excellent example of a couple of pieces. One, the head and shoulder top. Two, the need to allow our patterns to play out to be able to call them such, right? And three, the reminder that I put in the Twitter hit today is keep it simple. We don't have to overthink it. 20-day moving average was support until it wasn't. Once it broke, it became resistance. And it'll be resistance until it's not, until price action moves back through it, and then perhaps we can become support once again. All right, so there it is on home construction, home builders, essentially. Great rally in a window of time that you may not have been expecting it necessarily to rally based on what you may be hearing locally. The home builder space and the home and sales have been difficult to say the least, I believe. So it's been rallying in the face of some of that negative narrative. And yet here we are kind of pulling back and maybe finding support in the near term here. We'll see how this one goes, but we'll keep an eye on it as we always do. Now, while I was gone, our example portfolio lost out the one position we had. We've been working on a trade in RTX. So I just wanted to highlight this quickly. I'm going to put up the details of my trade. So I'm going to highlight the trades here. I no longer have orders in, but we bought it back here on a 20-day moving average support test. And we were able to hold it along the way, and it worked out beautifully for us. We did incorporate a stop order, and what you can see from the incorporation of the stop is that we got stopped out, unfortunately, at a spot that acted as support. And is that a drawdown? It is a drawdown as it relates to using stop orders, because we missed out on this pop, this rally back to new highs, 179.66, and it ended up costing us about 23 points. Am I disappointed in that? Of course. From a standpoint of being a trader, I would love it if all of my trades worked out to perfection, but I know better than that. Thanks to the 28 years of doing this, that's not the way the market works. So we did take advantage. We did get stopped out. We did make a trade in this example trade that worked out well. I mean, we made about almost 14 points on this position. Yes, we could have done a bit better. Some of that is tied to the fact that I was away, and some of that is maybe tied to the fact we should have been a little bit more diligent in assigning our stop order exits. But that's the way stops work. Remember, when you use a stop, it triggers and becomes a market order to sell. Okay, so we don't get any validation of price whatsoever. The goal, we did get a couple of instances. We got lucky back here. I think it was here and it was here. We had stops that were within 5 or 10 cents of the lows. So we definitely got lucky along the way. And I agree with you there. SSS, Heat X, better to make some than no money. I totally agree. That's what I want the takeaway to be here. These processes, using stop orders, regular traditional stop, trailing stop, trailing stop limits, etc. None of them are perfect. They're just designed to help us manage and mitigate our risk. We're never going to be the trader who sells at the peak, and we're never going to be the trader who buys at the bottom. And the moment we feel confident that that's the case, that we're not going to do that, I think we all are better as traders. Remember, you can deal with missing the first 10% of a move. You can deal with missing the bottom or the back end, the last 10% of a move, because in between you're capturing the burger portion, right? The 80% of that move. If you can capture 80% of an upside move every time, you're probably feeling pretty good about your process. All right, so I wanted to look at RTX very briefly because we got taken out of that. Now let's talk about one here that had earnings overnight was Tesla. Having a bit of a pullback as we speak. I'm going to eliminate some of my lines in here just to kind of clean this up. We've pulled back to an area that many are going to say is good support. And look at this, we're getting a bounce as we speak. So this is kind of a notable level. Let's kind of drill in a little on the Tesla chart. And as we do that, I want to bring in the headlines that I had from Tesla here. So the big ones were just tied, of course, to the earnings themselves. So the Wedbush analyst Dan Ives reiterated an outperform rating, and of course his $600 price target on Tesla. He's a perma bull as it relates to Tesla by and large. So do want to take that at least with a little bit of a grain of salt. But the level here to which we fell, that 414, sure seems pretty notable on this move. So on the intra-period chart, this is a 15-minute bar covering the last 5 trading sessions. That's the same white line, bounced right off of that same level around 414. Seems quite notable. Now, if let's go to that's a 1 hour. Okay, so we still have we're below our pivot here. So that's at 429 or so. That's a pretty notable level from a standpoint of a short-term basis here. I think a lot of traders are going to keep an eye on that. Is that pivot level. So being below that is not a win necessarily in the short run. But keeping an eye on this, you can suggest from a standpoint of how some traders will monitor trend, that 20-period exponential moving average, support in short-term rallies, resistance in short-term pullbacks. Maybe we are at a point where we're going to learn something about the rest of the day today. Basically, yesterday afternoon, which ends at 1400 here, you'll notice, you can see obviously the sell down from the earnings, but basically we've been below it since earnings. So knowing that, having all of that background, all of the news associated with this, if we simply stayed with the belief that we need to see this over the 20-period exponential moving average to be comfortable going long, we do not as of yet have that. So certainly not a guarantee by any stretch, but wanted to make sure that we looked at Tesla here. Now, because we no longer have a position in the market on our example portfolio, I thought we could put one on. So we could certainly do that here with Tesla, but I actually wanted to do so from an example standpoint only with Netflix, simply because it pulled back to its 200-day moving average and some horizontal support. And the reason I'm doing it is, one, to reiterate that we don't know what's coming from here, okay? And if you're a trader who's looked at the earnings that Netflix provided and then the concerns around their situation taxably with Brazil, and you don't have comfort, I understand. But when you find opportunities to buy a long-range performer at a long-range support, like the 200-day moving average, or on a weekly view, the 40-week moving average, notice how the instances there have been your opportunities. Well, sometimes you got to plug your nose and put on a risk-defined opportunity, and that's what we're going to do. So I'm going to simply put on a new position, small shares. We're not going to concern ourselves with a whole lot. We're just going to buy 25, and we're going to put a stop order by a proper percentage beneath this. I'm going to lean in and just default to a 3% move beneath. So we'll do a buy custom with stop. So we will go ahead and do a market purchase. And just real quickly, everybody, I'm going to take that 1100 and multiply it by 3%. That gives me 33 points. And then we're going to put it down at 1,067. Okay. And I totally understand that, Jay. I understand where y'all are coming from. Not everybody is going to be interested in buying without some semblance of an indication that the selling has run its course. That's a great reminder that Kahold could offer you that entrance. But I'm not getting it, and I will need to put on a position here because I want to give us something to monitor when I come back with you all next week. So we're going to go ahead and do it. We're going to put this on with a good till canceled stop at 1,067 under it. So I'm going to go down to 1066.94, my market entrance, and a good till canceled stop. Remember, the stop is simply a trigger, not a guarantee in price. Once triggered, I have a market order to buy. That means my entrance could be at a much higher price. It could be at a much lower price. So, or my sale, pardon me, on the stop could be at a much higher price. It could be at a much lower price. So simply, yeah, you're absolutely right, the Wire Rabbit. Buying the dip, not as much the trend, but And actually, I disagree on the trend comment because, again, if you look at here, we'll put that in. If you look at the weekly on this, many would say over a long range window, having held that pink 40-week moving average here, we've done enough from that standpoint to believe that it's as likely to hold at this area as it is to break. If it breaks, then we're out 3%. That's okay, or approximately 3%. A lot of traders would be comfortable with that. But again, build your trades around your comfort. That's what I want to remind you about there. All right, we're going to wrap it up, everybody. Thanks for joining me today. Big thanks to Brett Crowder here in the chat. Make sure you're following us on X, Kevin Horner CS, Brett Crowder CES, and I will be back a little later today with a ThinkScript conversation for you all. So hope to see you then, but if not, have a fantastic rest of your Thursday. We'll catch up soon.